Ever wonder how much credit card debt Americans really carry in 2025? Or how often fraud strikes? Today's numbers may surprise you. Credit cards are more than just plastic in your wallet. They reveal how people spend, save, and struggle. This video breaks down critical statistics on credit usage, fraud, interest rates, and more to give you a clear picture of the financial landscape. Stay with us and don't forget to like, share, and subscribe for more real-world financial insights. Credit card debt in America. Credit card debt in America has reached new heights in 2025, with total outstanding balances exceeding $1.13 trillion. This massive figure translates to an average of around $400 per person. But among active cardholders, it jumps to over $6,300. Several factors contribute to this surge: rising inflation, higher living costs, and stagnant wage growth. Many households now rely on credit for daily essentials like groceries, gas, and rent. Unfortunately, this habit leads to accumulating interest, especially with today's historically high APRs. Younger adults are among the hardest hit, carrying debt earlier due to education costs and increasing housing expenses. Credit card usage has become a necessity, not a luxury, and fewer people can afford to pay their balances in full. With an average credit utilization rate of 31%, well above the ideal 10–30% range, many Americans risk falling deeper into debt unless spending habits change soon. Credit cards v. debit cards. Even as financial experts warn about the dangers of debt, Americans continue to prefer credit cards over debit cards by a wide margin. In 2025, there are about 1.15 billion credit cards in circulation, compared to only 360 million debit-only cards, a 3-to-1 ratio. Why the preference? Credit cards offer rewards, travel perks, cashback, and better fraud protection than debit cards. Plus, they give users short-term borrowing power during emergencies or low cash periods. Most Americans carry at least 4 credit cards, each designated for different spending categories like groceries, travel, or business. Debit cards, while safer for budgeting, lack these extras and offer fewer protections against unauthorized charges. Online shoppers especially favor credit cards because they provide stronger security and better dispute resolution. However, credit use also comes with the risk of overspending. For many, the convenience and benefits outweigh the risk, until those balances come due with interest. Credit card fraud in the U.S. Credit card fraud remains a major issue in 2025, with 6.9% of all card transactions flagged as fraudulent. That's nearly $7 out of every $100 lost to scams, identity theft, or unauthorized purchases, totaling billions in annual losses. Although chip and mobile cards and mobile wallets promised added security, cybercriminals have adapted. Tactics like phishing, skimming, and data breaches still compromise millions of accounts each year. Even though most banks reimburse victims, temporary financial stress, credit damage, and long resolution times make the impact significant. Businesses too suffer financial hits from fraud, often passing costs to customers. Consumers are encouraged to take precautions, use two-factor authentication, review statements regularly, and avoid sharing card information online. Virtual credit cards and transaction alerts can help reduce risks. While federal protections exist, the growing complexity of fraud techniques highlights the need for continued awareness and vigilance in safeguarding personal financial data. Average credit card interest rates. In 2025, credit card interest rates have climbed to a record high average of 20.7%, making borrowing more expensive than ever. This jump follows recent Federal Reserve hikes aimed at curbing inflation, but the impact on consumers is severe. Just a few years ago, the average APR was under 17%, showing how quickly rates have surged. Cardholders with lower credit scores, especially subprime borrowers, often face rates of 28% to 30% or more, creating near insurmountable debt traps. Even previously attractive 0% APR promotions are now rare and harder to qualify for. For anyone carrying a balance, interest charges pile up fast, increasing monthly payments and delaying financial progress. Experts recommend paying more than the minimum, consolidating debt if possible, or contacting nonprofit credit counseling services. This high-interest environment stresses the importance of using credit strategically and paying off balances quickly to avoid long-term financial strain. Total available credit has reached historic levels. In 2025, total available credit in the U.S. has surpassed $4 trillion, the highest on record. This rise reflects both an increase in the number of active credit accounts and lenders boosting credit limits. While high credit availability can boost credit scores through lower utilization ratios, it also presents temptation. Many consumers interpret larger limits as permission to spend more, leading to higher balances and potential debt. Though the average utilization rate remains around 30%, which is considered acceptable, some lower-income users are at risk of overextension. With inflation still affecting household budgets, more Americans are leaning on credit to meet everyday expenses. Lenders have been generous so far, but rising delinquencies could cause banks to tighten access again. Experts urge consumers to treat available credit as a safety net, not a spending allowance, using it wisely to maintain healthy credit without falling into financial traps. Delinquency rates are rising again. Delinquency rates in the U.S. are climbing in 2025, reaching 3.2%, a significant jump from just 1.6% 2 years ago. A delinquency occurs when a credit card payment is over 30 days late, and it can have an immediate negative impact on a credit score. Rising inflation, job insecurity, and stagnant wages are key drivers pushing more Americans into this category. Many households depleted their emergency savings during the pandemic and now struggle to cover essentials without relying on credit. As interest rates rise and minimum payments increase, missed payments become more common. Younger adults and lower-income earners are especially affected, lacking the financial cushion to absorb economic shocks. If this trend continues, lenders may respond by reducing credit limits or tightening approval standards, which could limit access for those who need credit most. Staying current on payments remains crucial for protecting both your score and financial future. Credit scores are improving. Despite economic challenges, the average U.S. credit score has inched up to 717 in 2025. This improvement reflects better financial habits, increased credit education, and wider access to tools that help consumers manage their credit. Many people are taking advantage of credit monitoring apps, automated payments, and debt repayment plans to stay on track. While a score of 717 is considered good, disparities still exist. Older generations typically score higher due to longer credit histories, while younger borrowers average lower scores around 680. Credit mix also plays a role. Those with varied account types like auto loans, mortgages, and credit cards tend to have stronger scores. However, this upward trend may not last if delinquency and debt levels continue to rise. Maintaining a healthy score requires consistency, paying on time, keeping utilization low, and avoiding unnecessary credit inquiries. These simple steps are still the most reliable way to build and protect credit. Credit cards are tools, powerful when used smartly, risky when ignored. The numbers from 2025 reveal rising debt, growing fraud, and soaring interest rates, all of which demand your attention. Whether you're trying to improve your credit score or avoid financial pitfalls, staying informed is your best defense. If this video helped you understand the current credit landscape, please hit the like button, subscribe for more valuable updates, and share your thoughts in the comments below. Thanks for watching, and take care of your credit.